Lately, many countries have begun imposing anti-dumping duties on Chinese goods. Just within the past month, European Union has imposed on Chinese electric vehicles and maybe will start doing it on Chinese biofuels. India has imposed anti-dumping duty on some capital goods, or like heavy lifts, and Indonesia is proposing a host of taxes on several goods, garments, toys, furniture, host of things. A Republican win in the US can mean the mother of all tariff hikes on Chinese good. What's China done? To earn the world's attention when China is expanding manufacturing capacity at a time when its domestic demand at home is very weak. China's investment to GDP ratio, we understand, is 41%. Most of it is going into manufacturing because real estate is broken, so zero into real estate. Now this is being done to grab export markets, and so the share of China in export markets is increasing, leading to a crashing of prices. China's export price index, we understand, is at 2009 lows. Now what can be the impact on India and other rims on global demand if China continues this price undercutting, and how much worse can this situation get in case of a Trump victory? Republican victory. Let's understand it's from the top economic houses Morgan Stanley and Axis Bank latest report. Let's understand that how serious is the Chinese undercutting, how serious is the Chinese deflation, is a very serious challenge that China is facing. It's already been seeing GDP deflator in deflation for the 6th quarters now, and we think that this challenge is still likely to continue because at the heart of it, the whole approach that the policymakers are going ahead with is to continue to invest more in manufacturing and infrastructure to defend the real GDP growth line at around 5%, and they're not approaching it in the context of this investment by taking a call as to how much is truly needed in manufacturing, but the amount of credit that is flowing into manufacturing and infrastructure is being decided by the fact that there is a gap on growth that is created with real estate slowdown. And so whatever is the gap that is created needs to be filled by investment in manufacturing and infrastructure. And that approach is resulting into this excess capacity creation, and therefore depletion is persistent. So if you look at some of the new sectors in which they have put up huge excess capacities, solar batteries, EVs, and even old generation semiconductor chips prices are down anywhere in the range of 25 to 50% in solar. It is down as much as 50%. So this is the big deflationary force that is underway right now for the world. But those are the internal wellsprings that are prompting this kind of excessive output by China. How dire is the situation in the global markets? But that's pretty bad as well. So the global manufacturing, if you take December 19th as the starting point before the pandemic really started making things volatile, global manufacturing output is up about 89%. China's manufacturing output is up 30 to 33%. And so India is kind of keeping pace, maybe slightly above the US is doing kind of okay. But output is down significantly in the rest of the world. So Japan, Europe, I think things are looking really bad. So the global and demand, if you used retail sales as the proxy, real retail sales of the proxy is a kind of stuck at the, late 2020, early 2021 levels, and therefore the demand globally is definitely not growing. But what is most worrying? Add to what Jason is saying is that this is not the end of the story. And in fact, some of your, opening remarks seem to suggest that what is happening in China is new. Frankly, this is something that has been part of their business model, part of their economic model, or part of their governance model. For a very, very long time, even in the 1980s, during the 1990s, the decade of the 2000s, this whole model where you have access to a lot of surplus capital because of, systematic financial repression, what you do with that capital is what the government decides to do so. Move from real estate to manufacturing and manufacturing real estate. So right now they're moving to manufacturing the difference between the 1980s, 90s, the 2000s, and now as regards to that's the world is that China is now very big. That time was not big enough to really move the needle in a meaningful way, but today, on many of these sectors which they're starting to dominate, they are, I think, going to distort returns on assets for many, many economies. One last point here. This is so important systematically to corroborate with data what you're saying. If you see the increase year on year in the trade surplus, goods trade surplus in the month of June, which was about $29 billion, if you annualize that, may be inappropriate. But just for the sake of argument, it adds up to 1.9% of GDP, so almost 40% of the GDP, if you were to think like going at some 4.8%. So this incremental growth or expansion in the trade surplus is actually a very substantial part of the GDP growth. So it's going to be very hard to roll back. And if this trend continues, where they have added about $1.9 trillion in incremental credit to industry medium to long-term loans to industry. If this growth rate continues even at a slightly slower pace in the next 4 to 5 years, they could be adding another $2.5–3 trillion. So this is not the end of the story. And so I think the response of the rest of the world will also need to be much faster than it has been. So
do visit our website www.mintandprint.co.in and subscribe this channel for many more such informative videos from Financial World.